Welcome to Selling Condos, an agent's guide to successful transactions. Over the years, I have had different challenges throughout my career, and sometimes dealing with condos are confusing and it's a lot of red flags and you just want to have it's different than a traditional real estate transaction when you're dealing with townhomes and single family. So today we're stripping away the confusion so you can show, write, and negotiate and close condo deals confidently. Let's get started. So, a little bit about me. I have been in real estate for over 2 decades. I currently work in Northern Virginia, Maryland, and DC. I have experience with a different variety of loan types. I'm also a real estate trainer for real estate agents and mentor. And I also wrote a book called The Cost to Close. And I like to share with other agents different challenges I have dealt with over the years. So that's the reason for this training. Some people say, well, why are you training other people how to do this? Because I don't want people to basically go through what I've gone through. Or if this situation comes up, you are equipped and you know how to handle it. You say, oh, well, I'm confused. We don't want you to go online and get the wrong information. And sometimes if your broker has never dealt with it, they don't know how to answer your question. So that is why I created this. So let's get started. So, what you will learn in this course. So, this course is for condo transactions and it's to empower you to close more deals with confidence and expertise. So, the 7 fundamentals of condos, financing requirements and approvals, valuation techniques, and a bonus marketing strategies. So let's get started with the basics. So condos are not townhomes. They are definitely not co-ops either. What makes condos unique is the ownership structure. Your buyer owns the interior, walls in, while all exterior components and common areas are owned jointly through the association. This means shared responsibility, shared costs, shared governance, and shared risks. You will never close a safe condo transaction if you're not reviewing the condo documents. This includes declarations and bylaws, resale certificate, monthly financials, meeting minutes. These documents tell you everything: the stability, the upcoming assessments, the litigation, the reserve strength, and the governance quality. So it's not the responsibility of the agent to review the documents, but your client must review them. So it's going to not only tell you how much the condo fees are, but is it enough insurance for the community? What type of utilities are included? Is the water included? Is the trash included? Are the electricity included? Gas? What is the upkeep of the property? Are they short? Or is it a lot of delinquencies in the area? So those types of things. So here's what your clients need to know. So condos, you own the interior, you pay monthly fees, you share everything else. Governance is with the Condo Association Board. Townhomes, you own the structure and the land. The HOA is a little bit lighter, meaning that it is a little cheaper than what a condo would be. Fees are lower. And co-ops, you don't own real estate, you own shares in the building. Very strict board approval. You have to be approved to be able to even purchase in the community. And there's also special financing with that. So the key takeaway is that ownership type determines what type of loan you can get, what the resale value is going to be, the buyer pool, meaning, okay, well, if you have a lot of limitations, then that means your pool of buyers is very small. What's the risk for the buyer, for the lender, everything else? And then also future appreciation, because what I found that If the condo fee is significantly higher, if it's a high condo fee, the values won't, like, say for instance, if the condo fee is $1,000 a month, more than likely the the value is going to remain the same. It's going to go up a little bit, but it's not going to appreciate that much. So you should tell your clients is that, well, if you're looking for appreciation, then maybe if they can afford it, maybe a smaller townhome might make better sense. Because, in 10 years, it may not have improved that much. If it's a $1,000 condo fee, somebody has to want to pay that. And also if it's other challenges in the community as well. So, valuation factors. So, when you pull comparables for condos, it's not just price per square foot. Condos must be evaluated as a community, not just as a unit. So, critical impact items. So, these are going to be, in a lot of times, I'm telling you this, but you wouldn't know this up front, but this is going to determine basically the value overall. But you may not know this until you order the HOA documents, but this is a valuation aspect. So investor to owner ratio. If more than 50% of the units are investor owned, financing may be restricted. This reduces your buyer pool dramatically. So then you have the delinquency rate. If it's more than 15% of the units are behind on their dues, FHA and VA may be off the table. So that is going to limit your buyer pool as well. And also, if it's a conventional loan, they may need 15 to 20% as a down payment because the bank wants to, and the lender wants to mitigate their risk, because they feel that if you have more delinquencies on well, not HOA, but condos, then typically, the mortgage and other bills aren't going to start not being paid. And then also, as we know, well, you may not know this, the HOA and condo has the power to foreclose to get their money. Not if it's taking too long for them to get their fees. Yes, they can put a lien on the house, but if it's taking too long, they'll say, okay, well, this is dragging on. We got to get our money. So that's that. So then we have the master's insurance policy. This must be clean, current, and adequate coverage. So let's say the community needs at least $1.5 million to protect the building and structure. And if it's only $1 million, that's not enough. So the bank will say, well, no, you got to increase the coverage. And if they're not going to increase the coverage, then sorry to say that deal will be declined. So reserves. So the community needs to have at least 10% of the annual income in reserves. Anything less is a red flag. So the lender's not going to like that either. And so an important update. So this happened with the Fannie Mae guidelines in 2022. So older buildings are now required to have more documentation. This rule can kill deals when associations aren't prepared, because the structural integrity, they want to make sure that basically the building is not going to fall down. And is there actually adequate coverage to cover that with the master insurance policy? If something major happens, are we going to be able to fix the structure? So agents, this is why the condo questionnaires matter. This is where the condo value lives. So now, not every condo is financeable, and not every loan program is compatible with every building. So we have warrantable condos, which meet Fannie Mae and Freddie Mac guidelines. So conventional loans are allowed. They're easier approvals. You can finance with a uh, FHA and financing, VA financing, which I'm going to touch on that in a few. So non-warrantable condos. So these are the condos that have a high investor ratio. So that's what I talked about in the previous slide. So basically, say if you have 50% of the units are investors, that means 50% of them are, well, let me use a different scenario for math. So say you have let's say we have 55% of the units. So say it's 1,000 units, right? So then you have 55% of them are investors and then 45% are owners. So 55% of 1,000 units is 550 units, to give that in a better perspective. So that means 550 condos are investors and the remaining are owner occupied. So that means if it's an investor, they're renting it. So that means you have a high concentration of renters in the community, which most lenders, I won't say they frown upon it, they're fine if you're an investor, but they want a what they call a healthy balance between investor to owner ratios. And so also another item is litigation. If the community has a lot of litigation happening, then that's a challenge also. If it's major deferred maintenance, that's an issue. Insufficient reserves, too much commercial space. There These require portfolio lending or cash buyers. So check approvals before showing. It's going to save your buyer heartache and yourself from wasting time. So now we're going to discuss FHA approvals. So there is a lookup link that I'll put in the YouTube description below. So you will be able to see. You need to look up the community to make sure it's approved. And sometimes this happens. So keep this in mind. You can say, oh, well, I want to purchase in, 123 condo acres. Okay, that's great. But when a new construction building gets approved, they may get things approved based on the section and not the whole community. What they should do is after the community is finished, they should do a blanket approval instead of having, okay, well, section 2 is approved and then this, because they're all connected. But you got to be clear and understand what your community has. It might not just be a blanket approval. It might be certain sections. So maybe section 1 is approved, but then section 2 is not, or section 3 is not, or it might be in the same section, but this section was approved and the other one wasn't. So that's important as well. VAS is also the same. So it's actually a website that will tell you whether it's approved, or it may say it's approved, it's expired, or what have you. So if it doesn't say approved, then it's not. So you need to check with your lender to see if it's actually possible to get it approved. But if you're on the listing side, I would say go ahead and find this out ahead of time, because there's no need to market a house if you know that your pool of buyers is so small. You don't want somebody to write on a house that's not FHA approved or VA approved. That doesn't make sense, because you've wasted time. If you know ahead of time, like, these are things that are preventable to alleviate stress, because real estate is the most expensive thing that people will buy. We're not all buying jets and yachts and whatnot. So we want to make sure and minimize the amount of stress for our clients. So that's why I decided to do a webinar, so you will understand the different challenges for condos, because they can be challenging if you know what you're doing. So this step alone elevates you and makes you a high class agent, because you can talk educatedly on that. So let's talk about, okay, if you're a buyer's agent. So a couple best practices before you're showing a house, not house, before showing a condo. Check the condo approval status, understand the fee structure, and order or estimate the condo questionnaire cost. So probably not order it, but you should estimate it. I would say a good rule of thumb is $350, and this is cost that your buyer is going to have to incur with the lender. So they're going to have to pay for that. If they don't pay for it, it's not done. That's like when an appraisal comes in. The appraisal will not be ordered and completed until it's paid for. The condo questionnaire will not be ordered or completed until it's paid for. So, and that can delay the loan process. So you want to do that ASAP. So, and you want to make sure, based on the condo, not only is the condo approved with whether they're doing FHA or VA or those things, but you want to make sure with the condo fees and the mortgage payment, are the ratios going to be too tight? Because say, for instance, okay, your client can only go $3,000, not a dollar more, because their ratios are tight. So if the condo fee is going to bump them up to 3,100, yeah, that they're not going to be able to buy the house because the ratios are too high. So you want to make sure you know that it's not just PITI. We have to also include the monthly fees as well. So then second, during showings, make sure you see what's actually included. And if you can go visit the amenities, you should. And also with condos is a big thing. It's not on this slide, but listen to me. For parking, make sure your client parks in their parking spot that they will have and know where it is. Because let's say if they have a big vehicle and it doesn't fit, that could cause drama later. So you want to make sure any and everything that could potentially kill the deal later, or they're not going to be happy about it. Like, oh, I wish somebody had told me this. Now I got to downgrade my vehicle because it won't fit, or it's too tight, or I don't like where it is. So I like to eliminate, oh, I don't like that ahead of time. So I'm like, if you don't love the house, then we're not spending time writing on it, because it's still the back and forth with agents and this and this and that. So we want to make sure that the client is happy with all the amenities, all the features of the home before they write on it. So next, writing an offer. Use the condo specific contingencies. This protects the buyer if the association documents reveals issues, which with our associations documents, they're protected, but you want to make sure that your clients, it has time to review the documentation, because it's a lot of documents. You want to make sure that you're looking for any issues, challenges, or some of those things. So like an idea would be, okay, well, if it comes up that say for instance, the condo questionnaire says, okay, well, the ratios are too tight and then my client can't get the house, then they will pay for the condo questionnaire, something like that. Not saying they'll do it, but if you don't ask, you're not going to get. So after the contract is accepted, make sure that the agent has ordered the resale certificates, and make sure you know, based on where you are, when the deadline for review is, because every county, every state is different. So now, if we are a listing agent, we need guidance as well. So pre-listing prep: to position your listing correctly, gather the following out. Verify that the FHA and VA approval status through the online portals. Collect essential documents. If you can get those ahead of time, that would be great. So then you'll actually have that. You can't price correctly until you understand the building's health. Marketing: highlight what the condo fee covers. Buyers love clarity, not mystery fees. Also highlight parking, storage, pet policies, amenities, owner-occupied rates, strong reserves if they exist. Pricing strategy: warrantable condos are much stronger buyer pool. Non-warrantable means a smaller buyer pool and more strategic pricing, which more than likely is going to yield a cash buyer, which means a lower sales price. So this is where agents lose money for sellers. Don't be that agent. So now, red flags and risk management. These are deal killers. Spot them early. So top red flags, again, non-warrantable condos, pending special assessment. So say for instance, okay, well, we have to, it's a major structural issue with the building, and they also need to do new windows and all this kind of stuff. So the community, based on all the upgrades and updates that they need to do, the community has been slapped with a $2 million assessment. So everybody, based on the size of their home, has to pay that special assessment for whatever time. It could be a year, it could be 2 years. So that is going to be passed to the new buyer. And who is responsible for paying that? Well, you could negotiate that if you're on the purchasing side and say, well, the owner needs to pay for that. I don't want to pay for that, or we'll split the fees, or whatever. But you want to know that, because that's going to change what their monthly fee is going to be. Like, say if the monthly association dues are $400 and now you have this $8,000 fee that you have to pay, and it's divided monthly for like 2-3 years, that's going to impact the monthly payment. So make sure you understand that, and that's going to also impact their qualifying for their loan as well. So a lapse or miss master insurance. So this could actually happen too. They had adequate coverage when the property was covered, but now the insurance is not there. They missed the deadline to get it renewed. That could be complicated. So you got to look at dates. Sometimes like at the beginning of the year, sometimes you got to remember, okay, what year are we in? I know that sounds so simple, but yeah, make sure you look at the years. A high delinquency. If they're not paying 30 days, they look at 30 days. But I mean, if you have a lot of people that are delinquent in like that 60-90 day range, that's like a lot of red flags. Low reserves. If it's a high delinquency, the reserves will probably follow because it's not enough money. So we can't have reserves if we don't have enough money and it coming in. So that's just simple math. Active litigation, if it's something going on with the community. So could be a variety of reasons for litigation. Structural concerns, which, your buyer might want to walk away just based on that. So these are not just small issues. They impact financing, pricing, insurance, and resale value. Create a red flag checklist for every condo deal. I promise you, this will save you time and money. Thank you so much for joining me today. If you want to deepen your condo knowledge or get help with current condo transaction you're working on, don't hesitate to reach out. I love helping agents elevate their business and serve clients at a higher level. Master condos isn't optional. It's required for today's market. And now that you have a roadmap, it is time to make those sales. I'm Rashan Leaven, realtor with KW United. If you'd like to reach me, go to the link below. I can be reached at 240-284-4114.